Good afternoon, YouTubers. Benjamin Youngman here. Before we get started, just want to say this video is not for financial advice. You would have heard me say this many times. General disclaimer at the start of all videos. If you are going to make any financial decisions, please seek qualified financial advice from a licensed planner or a licensed financial advisor, and only make decisions based on your own objectives and goals. Do not go and pick a stock because I talk about it in this video. This video is not financial advice. I'm not qualified. I make these videos for entertainment value where I discuss different stocks, usually on the ASX. Today is a little bit different. We're going to pick an overseas stock. Now, this stock I'm going to talk about, November the 8th, 2019, is the first time I've done a video where I've picked an overseas stock. Usually I like to say with the Australian market, being an Australian resident, different tax advantages to picking Australian stocks, including franking credits, usually better dividend yields, and just locally knowing the Australian companies and being a consumer and being more confident with some of the local companies. I normally only pick ASX stocks. Today, I'm going to pick an American stock on the New York Stock Exchange. It's a very small company some of you may have heard of called Google. Parent company Alphabet, ticker code GOOG, Google. You're probably wondering, why am I picking such a large company, such a mature company? It's very obvious. Everyone knows about it. It's been successful for many years, so why would I pick it now? I've missed the run. There's a lot of growth in front of some of these big companies, and you have to remember they didn't get there by mistake, by chance. You might make the assumption that some of these very large, well-known, very investable tech stocks, especially in America, in the NASDAQ and so on, you might think you've missed the run. The growth is over. You've missed that window. What's next? And you'd be mistaken sometimes. Now, Google listed in 2004 at $85 a share. At a market cap of $617 million. That's where they floated, okay, in 2004. Now, in 2012 was the first time that Google hit $50 billion a year in total revenues, 7 years ago. Fast forward 7 years to 2019, and their revenue for last financial year was $155 billion. So it took them forever, okay? It took them over almost a decade, okay, from when they listed to hit $50 billion a year. 7 years later, they've tripled that revenue, $155 billion. They have 20% quarterly revenue growth for the company. Now, some of these very well-known companies, they carry a ton of debt. And even though they're large and they can manage debt normally a lot better than a small cap or a micro cap or something of that nature, assumably or presumably rather, Google doesn't carry as much debt as some of its peers. Okay, it doesn't carry as much debt as, say, Apple or Microsoft, for example. They have $14 billion in total debt, almost $15 billion in debt. Now you might be thinking that's a lot. I mean, that's a lot of money, $15,000 million in debt. They also have $121 billion in cash sitting on their balance sheet. They are more than capable of paying down those debts when they fall due, if not wiping them out completely. Having $121 billion on your balance sheet, it gives you room for acquisitions, for future investment, future growth. Google have their hands in a lot of pies. Their primary revenue stream still today comes from Google AdWords. About $110 billion approximately of the $155 billion comes from Google AdWords, from advertisers. That's a little bit scary, knowing that their revenue is skewed to one area. About 70% of the revenue is skewed to one area. But they're very good at what they do. They have a strong monopoly on the market. I'm not a big fan of monopolies. I use the term loosely. Monopolies never see the disruption that's coming for them. So they might not have that market dominance forever, but they do at the moment. And like I said, they've got enough money, enough brains, enough leverage to move into different fields. moving forward as technology grows. Google is well positioned. They have Google Cloud Services. They have plenty of businesses. I mean, Google is such a huge machine. You might be thinking, well, okay, they've got a lot of money. They're growing well. They've done well over the years, but have I missed the boat? They're still growing very well. Now, for a high growth company and such a company with such a strong balance sheet and market position, such a strong economic moat around it, you'd think they might have a very high price to earnings ratio, which makes them too expensive. They have a forward price to earnings ratio of 24. Now, for such a big growth company, that is a little bit toppy, but it's not crazy. A lot of our tech companies are between 50 and 150 times price to earnings. So you move over to America, and your price to earnings ratio for a lot of the companies are a lot cheaper than the Australian tech stocks. And if you had to pick an Australian tech stock and invest in it versus an overseas tech stock, you'd be pretty hard pressed to find better value than Google in anything we have here at home. Today's price for Google is $1,308 American. That translates to about 2,000 Australian dollars for a single share. Now, Google doesn't pay a dividend from what I can see. So that is a disadvantage. You can really grow a great portfolio long term if you have dividends that are reinvested into the company, and having that compound effect is a really magical thing. This is only a small part of my portfolio. Pardon me, this Google share. So the fact that it doesn't pay a dividend doesn't really bother me. I've got plenty of good dividend paying companies with growth in Australia. I did want a good tech company in my portfolio, and I had to look overseas to get one of great value, believe it or not. There are some on my watch list that are wonderful, wonderful companies here in Australia. They're just too toppy. Our tech companies are way overvalued, and you might think that's fine. It's okay. Plenty of you haven't been around long enough to have witnessed the dot-com bubble or really been hurt from the great financial crisis of the housing bubble. Historically, when the market's overvalued, a correction will come eventually. And when you're inside the bubble, you can't see the pin coming to poke it. Okay. So if you are paying 50, 60, 70, 80 times price earnings for our Australian tech stocks, I would warn you, as good as the growth has been over the years, be very, very careful. Okay. There was a famous general in America many, many decades ago called General Patton. He coined the phrase, walk lightly and carry a big stick. I would say if you're investing in Australian tech companies, walk very carefully and carry a big stick. The big stick being cash, and being very careful with where you step. Okay, you step on a landmine, you're gone. Don't pay too much for Australian tech stocks. The bubble will burst. Okay, our wax stocks, they call them, since June have actually decreased as a whole. That's something you'll find when the market starts correcting itself. These overvalued companies will be hit first. There's some wonderful companies in our tech stocks like Jumbo Interactive, Appen, even Altium, things like that. They're way too pricey, so be very careful having a portfolio that's weighted in this area. Google is the one I'm talking about today. Okay, as I said, it came out with a market cap in 2004 of $617 million. They have a market cap today of $889 billion, almost at $1 trillion. Again, you'll be thinking that's getting a little bit expensive, a little bit toppy. We had our first $1 trillion company this year. Was I believe it was Apple, and then Amazon followed. They both pulled back, went under $1 trillion. Now Microsoft's over $1 trillion. It seems very unusual, but looking forward in 5 to 10 years, $10 trillion would be the next benchmark, and then 20 trillion. And times change. Google, in my opinion, is not too expensive. While it's relatively high, it's not too expensive, and it's a great company to invest in for the future. It is very expensive. So if you're a normal everyday worker like I am, I'm not rich by any means. What I do is I invest between $1,000 and $1,500 every month if I can, and over the long term, just dollar cost average into my portfolio. So I've only purchased one Google share. So that would be laughable for some of you that are very wealthy. So one Google share. I'm happy to purchase more in the future. as my portfolio grows. But that's my stock pick for this month. Ticker code GOOG. Like I said, almost 2,000 Australian dollars for one Google share. Wonderful, wonderful company. Great balance sheet, strong fundamentals. You have not missed the window, the run up for this company. I think there's many, 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 many years of success in front of this company. But again, we always monitor these things closely and watch the evolution of them. At the moment, I think there's great value at today's price, as expensive as you might think it is. Have fun, look at Google, happy investing, see what you think. If you can afford some Google shares, great. If you can't, so be it. It's my personal opinion. I think Google's a wonderful company today. 8th of November 2019, American tech company is my stock pick. Have fun. Thanks for watching. Happy investing. Bye.